What if I told you that by the end of 2026, you could have a passive income engine built from just 5 UK dividend stocks, collecting quarterly checks, compounding, and letting your money work harder than you do? In this video, I'm going to walk you through what I believe are the top 5 UK dividend stocks you should seriously consider right now, and why. No fluff, no stories, just cold, hard analysis, risk checks, and actionable steps. Let's dive in. Before we jump into specific names, I want to set the stage. It's critical the audience understands why UK dividend stocks may be compelling and what dangers to watch out for. The UK stock market, especially FTSE's large-cap stocks, tends to include many companies in mature sectors, utilities, energy, consumer staples, financials, that have historically paid dividends. In a low to mid-growth environment, dividends become a more important component of total returns. If interest rates remain sticky or decline modestly, dividend yields might look more attractive relative to bonds or cash. That said, headwinds, inflation, regulatory risk, especially for energy, tobacco, utilities, currency risk for global revenues translated back to GBP, and dividend cuts in downturns. So the stocks I pick should have sustainable payout ratios, healthy cash flows, a dividend track record or visibility, some margin for growth or resilience, defensibility in their sector. I'll lean toward names that score well across these dimensions, not just yield. Pick number 1, British American Tobacco, BAT. British American Tobacco is one of the highest yield names in the UK dividend universe. Many dividend lists, e.g. UK Dividend Stocks Top 40, rank it highly based on yield plus consistency. It pays out a strong dividend, has global reach, and a relatively stable cash business, even if smoking volumes decline, next-gen products and pricing power help. Strong cash flow? Even as the traditional tobacco business faces decline, BAT has been investing in next-gen and smokeless products, which gives it optionality over time. Yield appeal: for income investors, this is a juicy pick. Scale and global diversification: it operates in many markets, which gives flexibility to absorb regional headwinds. Dividend history: it has, in many years, been a mainstay dividend pair in the UK market. Risks: red flags. Regulatory risk: governments can raise taxes, impose more restrictions, or push toward outright bans on certain products. Decline in core business: if volumes decline faster than expected, margins may compress. Currency risk: because a lot of revenue is global, GBP fluctuations affect earnings. Public perception and ESG pressure: some institutional investors avoid tobacco stocks due to social, ethical, governance concerns. Forecast and why I pick it for 2026. I believe that in 2026, BAT will still generate substantial free cash flows which can support its dividend. The yield will be a strong anchor, and if they manage cost discipline plus growth in next-gen products, there's modest upside to the share price too. A hypothetical modeling, say BAT yields 7% at entry, and they grow the dividend 3 to 4% annually, plus modest share appreciation over 2 years, that becomes a nice total return. So BAT is my pick number 1. Pick number 2, Aviva plc. Aviva is one of the major insurers in the UK. It recently made headlines by raising its interim dividend after posting strong half-year results. Insurance companies, especially life and general insurers, tend to generate reliable cash flows, particularly when interest rate environments are favorable and capital reserves are healthy. Financial strength and balance sheet: insurers tend to carry reserves, which gives a buffer. Growth via acquisition and consolidation: Aviva's move to acquire Direct Line, completed in 2025, gives it scale and potential cost synergies. Dividend raising momentum: they've already indicated confidence by raising interim dividends. Diverse insurance segments: it's not just one business line, general insurance, life, health, etc. 3.3 Risks, red flags. Underwriting risks: claim surge, catastrophic events, inflation, or pandemics can push claims higher. Interest rate exposure: insurers invest in fixed income assets, rate declines or yield curve shifts can hurt investment returns. Regulatory capital constraints, insurance is heavily regulated, and solvency rules matter. Integration risk, the direct line acquisition may or may not deliver all assumed synergies. Forecast and rationale for 2026. I believe Aviva is well positioned for 2026 to deliver a meaningful dividend increase if underwriting remains disciplined, and possibly some multiple expansion as investors regain confidence in UK financials. Given that it just raised its interim dividend by 10% on the back of robust profit growth, that sends a signal that management is in shareholder-first mode. Pick number 3, Unilever plc, ULVR. Why Unilever deserves a seat on this list. Unilever is one of those companies that doesn't get flashy headlines, but quietly compounds wealth decade after decade. It's a global consumer goods powerhouse, with brands in virtually every supermarket aisle: Dove, Ben & Jerry's, Hellmann's, Vaseline, Persil, Lifebuoy, and Magnum, just to name a few. And that's exactly what makes it a classic dividend stock: predictable demand, pricing power, and global diversification. Strong brand moat, people still buy Unilever's products regardless of economic cycles. These brands have deep consumer loyalty. Resilient cash flows, even during downturns, consumer staples hold up. Consistent dividend growth, Unilever has paid dividends every year for over half a century, with incremental growth most years. Emerging markets exposure, about 58% of Unilever's revenues come from emerging markets, which gives it long-term growth upside. Risks: red flags. Margin pressure from inflation, rising input costs, packaging, energy, transport, can squeeze margins if they can't pass those on. Currency headwinds, global exposure means FX volatility can distort results. Growth stagnation risk, mature product portfolio sometimes grows slower than inflation. ESG and activist investor pressure, Unilever has faced scrutiny for trying to appear too woke in brand messaging, which can distract from execution. Unilever is exactly the kind of sleep well at night dividend stock that complements high-yield names like BAT. You're not betting on huge growth here, you're buying reliability. Its payout ratio remains in the sustainable 65 to 70% range, and it tends to grow dividends by about 3 to 5% annually. If you're reinvesting dividends, the compounding becomes powerful, especially if sentiment on UK consumer staples improves. So, Unilever is my pick number 3 for 2026. Pick number 4, Legal and General Group plc, LGEN. Why it's on the radar. Legal and General is one of the UK's largest financial services groups, spanning insurance, investment management, pensions, and annuities. For dividend investors, LGEN is a hidden gem because it offers one of the most generous yields among blue-chip names, often above 7%. Strong institutional presence, LGEN is a major player in asset management through Legal and General Investment Management, LGIM. Predictable recurring income, its pension and annuity businesses throw off stable cash flows. Attractive dividend policy, management has historically targeted progressive dividend growth. Capital discipline, despite economic volatility, LGEN maintains a strong Solvency II ratio, well above regulatory requirements. Risks: red flags. Interest rate sensitivity, pension and annuity valuations fluctuate with bond yields. Longevity risk, if people live longer than expected, annuity payouts last longer, impacting profitability. Market risk, LGIM's asset management arm is exposed to market volatility. Regulatory oversight. As with any large financial institution, capital adequacy rules can limit payout flexibility. Legal and General has maintained a long record of dividend payments and a willingness to reward shareholders through consistent increases. For 2026, the thesis is clear: steady, dependable yield with moderate upside. If bond yields stabilize, asset values recover, and capital ratios remain robust, LGEN's dividends are safe, and could even grow mid-single digits. Combine that with potential capital appreciation if the UK market re-rates, and you've got one of the most balanced high-yield income plays in the region. Legal and General earns pick number 4. Pick number 5, National Grid plc, NG. Why National Grid rounds out the top 5? National Grid is the backbone of UK energy distribution, owning and operating electricity and gas transmission networks. While it's not a growth rocket, it is one of the most stable, regulated businesses you can own in the UK. When people flip a light switch, National Grid earns money. It's that simple. Regulated monopoly, it's virtually irreplaceable in its infrastructure role. Predictable cash flows, regulated returns mean investors can forecast income more reliably than in most sectors. Dividend consistency, historically, National Grid has paid and grown its dividend every year for over 2 decades. Energy transition exposure, as the UK pushes toward net zero and renewables, National Grid is heavily involved in new infrastructure investment. Risks: red flags. Regulatory caps. Returns are controlled by regulators, so there's limited upside. Capex heavy. The company reinvests billions annually in upgrades, which increases debt levels. Political risk. Utilities can become political punching bags when energy prices spike. Interest rate exposure. Higher borrowing costs reduce free cash flow. For 2026, National Grid offers something every portfolio needs: stability. Its yield, around 5%. Might not top the list, but the reliability of its dividend growth more than compensates. In an environment where investors may still be nervous about volatility, National Grid provides defensive income that can anchor your dividend portfolio. That's why National Grid is my pick number 5. Alright, now let's zoom out. You've got 5 quality UK dividend stocks. British American Tobacco, BAT, high yield, cash cow, risk, regulation. Aviva plc, financial strength, growing dividends, risk, underwriting volatility. Unilever plc, defensive consumer staple, slow but steady growth. Legal and General Group, LGEN, high yield, financial resilience. National Grid plc, NG. Stable, regulated cash generator. If you built an equal-weighted portfolio of these 5, you get an average yield of around 6%, with broad sector diversification: tobacco, insurance, consumer staples, asset management, and utilities. That gives a blend of high yield, BAT, LGEN. Dividend growth, Unilever, Aviva. Stability, National Grid. It's a mix that can handle different macro scenarios. Now, here's where Graham Stephan's philosophy comes in. It's not just about collecting dividends, it's about reinvesting them. If you reinvest your dividends each quarter or year, you can accelerate compounding dramatically. Over a 5 to 10 year period, reinvesting a 6% yield can nearly double your capital, even without massive price appreciation. That's the quiet magic of compounding, and it's what makes dividend investing so powerful for building long-term wealth. For UK investors, remember the dividend allowance has been shrinking. It's £500 for the 2024-25 tax year. So you'll want to hold dividend stocks in tax-efficient wrappers like an ISA or SIPP to protect your yield from tax drag. While those are my top 5, a few others deserve a quick mention. Diageo plc, DGE, another consumer staple giant with strong brands and global reach, but currently facing margin pressure. Shell plc, Shell. A strong dividend pair after its recovery post-2020 cuts, though energy volatility remains a risk. Vodafone Group plc, VOD, historically high yield, but under pressure to maintain payouts amid restructuring. HSBC Holdings, HSBA, global bank with renewed dividend focus after strong capital ratios in 2024-25. If you want slightly more risk for potentially higher yield, these could be explored, but the core 5 remain the more stable foundation. If you're looking to actually build your dividend portfolio, I recommend using Free Trade or Interactive Investor. Both have strong access to UK and global dividend stocks, easy dividend reinvestment options, and low fees. You can find the link in the description, and if you sign up through that link, you'll get a free share worth up to £100 to start your investing journey. Also, don't forget to grab a free trial of SimplyWall ST. It's one of my favorite tools for dividend stock screening, analyzing payout ratios, and tracking long-term returns visually. If there's one takeaway, it's this: dividend investing is about patience, not prediction. You're not chasing the next Tesla here, you're buying companies that quietly make you money every quarter. And if you do it right, if you stay consistent, reinvest dividends, and avoid emotional reactions, you'll wake up a few years from now with a portfolio that not only pays you but outperforms most traders. That's the kind of boring wealth creation that actually works. So, those are my top 5 UK dividend stocks for 2026, but what about you? Are you focusing more on yield, dividend growth, or capital appreciation? Drop your strategy in the comments below. And if you found this helpful, hit that like button, subscribe, and check out the links in the description for the best investing tools I personally use. With that said, thanks for watching, and until next time.